Hello and welcome to the Money Metaphors podcast with your host, Jason Coddington. Jason, good to be with you again. How are you?
Good to be with you. Yeah, we're doing well here.
Yeah,
So
yeah, it's interesting. The topic that's on the table for discussion today, I am extremely interested in because I have been doing business and financial news for several decades, and I was not familiar with the QCD, if you will. So the floor is yours to explain what exactly that is and how it works and how it might benefit.
yeah, that's leave it to us to the financial industry in Congress to come up with another acronym, right? So,
Exactly.
yeah, I mean my word alphabet soup. But yeah, so a qualified charitable deduction, so a
Mm,
QCD if you hear that. So may sound like something new. Actually, it's just something that has paired are peeled off of, if you what's called something called the required minimum distribution that is required for now all those individuals that have retirement accounts over the age of 73,
yeah,
soon to be 74, based on current tax law. So uh, we'll just kind of walk through that today. I think it's exciting for me to talk about this topic in the sense that ultimately it does a couple of things if you're knowledgeable based on the current tax code. And one is that you can save money on taxes, which most people like, but you can benefit a charity and, if done correctly, perhaps leverage and give more because of the tax savings. So we'll talk a little bit about that.
great.
Um, and it's just a nice thing. So I guess today, if you are 73 or over and you happen to be listening to this today, review this with your advisors or tax consultant. And if you're not 73 yet, maybe you have some or know someone that is, or if you happen to be a charity and come across this podcast, speak to your members or donors list that are in that age, and this will probably be beneficial way to look at giving. So hopefully you learn something, and we'll have some takeaways at the end. But we'll just start real quick. So as I mentioned, the required minimum distribution is required. The IRS requires you to, after 73, if you have money in your IRA,
Mhm.
um, or an inactive retirement plan, that you take money out of your requirement. Well, excuse me, if you have a retirement plan, you've got to take money out at 73. So there is a publication 580. The IRS has some tables in there based on your age, and you have to take money out. Typically, to start at 73, it's about 4% of all of your balances in there. So
Wow.
if you have $100,000 in an IRA at age 73, you got to take $4,000 out. If you don't, there's some penalties. And so keep in mind, the required minimum distribution exists because this money it went in typically pre-tax. It's grown tax-free for quite some time. And now it's time to start taking that money out and paying tax with it. So, but in 2017, there was an act passed, the TCJA Tax Cut and Jobs Act of 2017. Um, basically, made this current law, made it permanent. So what's nice about it is you have a qualified charitable deduction that exists.
Hmm.
So if you're 73 and you want to take a distribution, instead of taking it personally, you can send it. And this is absolutely critical. This piece I'll mention here, you can send it directly to the charity. So you can't take receipt of the money and then give it to the charity. The money's got to go directly to a structured 501c certified uh, charity. Could be a church, could be an organization that you support, local cancer. In our community, we have a
Mhm.
cancer volunteer organization that would qualify, a booster club for a softball team if you would like. Any of that is eligible. So instead of taking the money directly, you give it to the charity. Now, why does this work and why is this impactful? Uh, is because under current law, uh, it's kind of if you took the money, and we'll give an example here of a couple, probably will explain it a little bit better. But if you just take the money, let's say we'll take a couple that has to take out $20,000 from their
Okay.
IRAs. Effective tax rate 20%, $20,000, 20%, they're going to pay $4,000 in tax. If they were already giving money to charitable organizations, they could have, let's say they're giving $10,000 a year to their local charities. They could have 10,000 of that 20,000 go directly to those charities. And now they only have $10,000 of income, and that reduces their tax bill from 4,000 to 2,000. So
Right.
if you have charitably inclined individuals, this is, and they're already giving, it's part of their normal, modus operandi, if you will,
Right.
then, having the money come from your IRA to the charity directly will save you money in tax. And
Well,
so,
Jason, let me just, so I'm clear.
yeah,
If I am that couple and my wife and I take out that $20,000, you're saying I could direct $10,000 directly to a charity of my of our choosing, and transfer the other 10,000 into another one of our accounts. Is that how it would
correct.
work? Okay.
Yeah, or you can do the entire amount. You could do the entire 20,000 to charity if you'd like.
Okay.
And currently there's an exclusion. This is kind of new. You can do a one-time, over, I think currently I believe it's $100,000 to a charity one time. So let's say
Hmm.
if your RMD is 20,000, they'll let you do a one-time $100,000 up to $100,000. So if you're just feeling like, it's been a good year, like last year in the market, S&P 500 was up 26%. If you're feeling, generous with the earnings, and you want to give it to charity, you can do that and not have any income tax implication on that. And I think
But the key here is that my wife and I can't take the 20K and then send a check to the
so
organization for 10K.
we'll walk through that right now because
Okay. All right.
yeah. So you want to talk wherever your IRA is, at a bank, a brokerage firm, you pick wherever that money rests. You'll want to
Yes.
instruct them, and all of the firms, major firms, are aware of this now, so they have forms for this. You'll want to have your, the money directly sent to the institution, their mailing
Gotcha.
address, if they have wiring capabilities or electronic transfer, you can do that as well. But the key part of that is, I think a lot of people don't know about this. And so they're in their their mid to late 70s, and they're taking these distributions, and they're also giving.
Yeah.
So all they have to do is just change the strategy a little bit and not take the money personally and just have it directly sent, and they'll save, you know, their effective tax rate, but we'll just use 20%, federally here. And, and here in California, you can add another 5 up to 9% of tax savings as well. So we're reducing you're reducing your taxable income, but not reducing your giving. And that's the benefit.
Gotcha.
And what makes this a little unique is part of that, the Tax Cut and Jobs Act of 2017. They the Congress passed, the IRS now issues this. They raised the standard deduction for those. So, if you're someone married, if you're married, if you're, it's, you get a standard deduction of $13,850 if on your 2023 taxes. That means that if you don't have enough deductions to get over that amount, you're going to get that as a deduction, just standard. So the tax job.
Ah.
So see,
So
here's where the
this is
trick.
outside of, so QCD would be outside of that set of standard deductions.
Yeah. So what people are doing, what with in the past, they would take their money from their IRA, then they would give it to charity. They'd pay tax on the income, and then they
Yeah.
would use the deduction to get up. They would use the charitable contribution to get their itemized deductions higher than the standard deduction. But
Yeah.
now, since 2017, they increased. A married couple, their standard deduction combined is, 27,700 for 2023. So if you don't have itemized deductions, which most people don't,
Yeah.
that exceed 27,700, then you can see the two different strategies here. If you take the ordinary income, take your required minimum distribution directly and then give it to charity, you've had higher income, and you're not gonna really probably be able to itemize.
Yeah.
However, if you have the money taken directly or sent directly to a charity, and if your itemized deductions don't meet, let's say they're not over 27,000, you get to take the standard deduction, which is all of it, all 27,700 if you're a married couple, 13,850 if you're single. So it's a way to use the current tax law and help benefit charities and put more money in your pocket. And I think what's nice about that is, let's assume someone we'll use that same example of 20,000. And let's say they want to give all of it to charity. They're very charitable people. They're just all they have to
Yeah.
do, instead of sending the check to them, they call their bank or brokerage firm and say, send the check to my local church. The 20,000 goes to that church, and then they save 20% in taxes. So what they can do is that $4,000 tax savings that was there, they can take that and use that and spend it on themselves, or they can take that money and use it and give more to a charity if they would like. So a little bit more leverage on their money. And I think this is the big one is, for me is, we like faith-based organizations and those people in their own communities that are
Yeah.
rolling up their sleeves and getting that done. I think that's one of the things we mentioned in one of our first two podcasts.
Yep. It was.
And we believe that, the local communities, the local charities, even some of the national ones, spend their resources a little bit better than the federal government. So,
Imagine that.
you know, with a $4 trillion budget, money is spent at $200,000 a second, plus or minus. So, our charities might spend a little bit better. So,
Yeah.
and
So
so
how
that's,
hard is this? Well, first, so I'm clear on the qualifications. What are the qualifications? Then how do you do it?
well, you need to be of age. So in this particular case, 73 in current,
Okay.
for 2023, 24. And so therefore you're subject to, an IRA. Now, if you have a retirement account, to do this, like a SEP IRA or a simple IRA,
Yeah.
you can't be an active contributor to it. So it has to be, you can have a simple IRA, but you can't be an active contributor to it. Most people aren't active at age 73 or 74. So those are kind of some two hurdles. So eligible for a required minimum distribution, an inactive IRA account, and it just means you're not contributing to it. And most importantly, you have a qualified charitable deduction that you're going to send this to. So it's qualified charity under the IRS code 501c3. We do have, there's been some questions like, well, hey, could I just give it to a private foundation or a donor advised fund? And those are not eligible.
Okay.
So, those are not eligible for contribution. And then of course you can do that $100,000 one time, provided you're of age. So
So how do you do that?
so you meet with your representative. Like if you were working with me, you would come in, we'd have a conversation, and we would say, are you feel charitably inclined? They would say yes. Well, for example, we'll use the same 20,000, Mr. and Mrs. Smith. Your IRA, we've calculated based on what you have. Your required minimum distribution this year is $20,000. Are there some charities you would like to help out?
Hmm.
I say, sure. Well, we're already helping this. And they might say, let's say it's the Red Cross.
Okay.
So, okay, well, if you would like to support the Red Cross, here's a different way to do it. If you have some information on where we can send contributions to the Red Cross, we'll help you complete the paperwork so that you can have your required minimum distribution sent directly to the Red Cross, and save you some money on your tax bill. And we would just say that, you'll have records of it, but keep your receipts when you get them from the Red Cross, so that, if there's any question in the future on your tax return about that, you would have proof to document that.
Can you do it to multiple organizations in a year?
Absolutely. We
Yeah.
have plenty of clients do that. So typically most places, most institution, banks, brokerage houses, financial advisory firms, they have what's called a third party distribution form. So, there's typically three parties. So the brokerage firm, you, and your wife, let's say, and then the third party, the Red Cross in this example.
Yeah.
And that's how we get it done for our clients. And that's how it's done mostly. But I definitely think if you're listening to this today and say, hey, that piqued my interest, I think it's something to consider, and look into, because it's just, most people don't know about it. And the reason I believe that it's less well known is, we had, every so often we have reviewers from our corporate office come into our office and say, hey, we just want to take a look, make sure, you're compliant, doing things right. And we welcome those visits. And they said that, they were reviewing our quote unquote third party distributions. And they had said,
Yeah.
you do quite a bit of that. And we said, yeah, we do. And why is that? And I'm like, well, I'm shocked that we do more than the average bear, so to speak,
Yeah.
because the qualified distribution is one of the, bright spots in the tax code, because it helps
Sure.
reduce income tax and it helps charities. So, um, I believe it's lesser well known than most, and it's really not difficult to do. So,
No,
uh,
great. So to put a kind of pin in this episode, if you are listening to this and you are charitably inclined, if you're looking at required minimum distributions, you should sit down with either Jason, if he's your financial advisor, or whoever is your financial advisor, and talk to them about this, right?
yeah, I think that's the next step. And and I think if it's also, if you're already giving, and maybe this is another concept that we suggest, is if there's another charity you'd like to benefit, um, you know, maybe there's one more you would like to help and you just haven't thought of helping. Maybe this has triggered that thought, and that would be good. So, and I think for most organizations, at least that I've experienced with, every little bit helps.
Yeah.
And so, and don't feel like if you need to live on some of it, uh, don't feel like you have to do the whole amount. But
Right.
if you're giving anyway, and most people that I know, especially in smaller communities, they're charitably inclined individuals. Just change the way you give, and you can, save some taxes. So,
Fantastic. Well, if anybody's listening to this, Jason, they would like to talk to you about this further, how would they reach out to you?
think, on our, you can give us a call. Our phone number, 559-897-0040. Also, they could visit our website at www.coddingtonwealthadvisors.com. There'll be a little button in the upper right-hand corner where they can schedule a meeting or a brief phone call, and we can go over it that way. And then, of course, the show notes that'll be here will have some links if people want some additional resources as well.
That's
So,
great. This is an interesting conversation and a timely one as well.
right. Because if you're going through now and you're looking at your taxes, and you're like, oh, how next year, what could I do different? This might be that thing. So,
This might be just it. Great. Thank you, Jason. Appreciate it. For those of you who are listening and you are not a subscriber, they just talked about little buttons in right-hand corners. Look at the subscribe button there and hit it. That way you will be subscribed to the podcast and you won't miss another episode. When Jason puts out another episode of Money Metaphors, you'll be notified. Simple as that. If you like it, we'd also ask that you share it with other people and spread the word about the podcast. Until next time, I'm Bill Tucker on behalf of Jason and everybody at Money Metaphors. Thank you for listening today and reminding you that you can go out today and have a great day or not. It is your choice. Thank you so much for listening.